In today's globalized financial landscape, businesses of all sizes face increased scrutiny from regulators, partners, and clients to ensure they are not inadvertently facilitating money laundering or other illicit activities. Anti-money laundering policies serve as a critical safeguard against these risks, but many companies underestimate their importance or fail to implement them effectively. Weak or poorly enforced AML policies can have far-reaching consequences that go beyond regulatory fines. They can destabilize operations, tarnish reputations, and even lead to the collapse of the business. Below, I'll explore the multifaceted dangers of weak AML compliance and provide actionable steps for businesses to mitigate these risks. Non-compliance with AML regulations can result in severe financial penalties. In recent years, regulatory bodies worldwide have shown zero tolerance for lapses, handing out billions of dollars in fines annually. For example, a financial institution might face penalties for failing to perform adequate customer due diligence (CDD), or neglecting to report suspicious transactions. These fines can cripple a company's financial health, especially small and medium-sized businesses (SMBs), that lack the resources to absorb such losses. But the consequences don't end with fines. Businesses can also face legal repercussions, including lawsuits from victims of financial crime who claim the business facilitated fraudulent activities, criminal charges against executives if complicity in money laundering schemes is proven. Reputation is an intangible yet invaluable asset. Weak AML policies can irreparably harm a company's standing in the market. Being implicated in a money laundering scandal, even unintentionally, can result in loss of customer confidence, termination of partnerships or supplier contracts, blacklisting by financial institutions and industry peers. For instance, clients and investors often prioritize working with businesses that demonstrate ethical practices and robust compliance measures. Failing to meet these expectations can lead to long-term reputational harm that stunts growth. Operational disruptions and internal risk. When a business becomes the subject of a regulatory investigation due to inadequate AML controls, the disruption can be significant. Resource diversion. Key personnel may need to focus on audits, investigations, or legal proceedings instead of core business activities. System overhaul. If compliance deficiencies are identified, the business may be required to overhaul systems and processes under tight deadlines, creating additional costs and stress. Internally, weak AML policies also increase the risk of fraud and corruption. Employees, vendors, or third parties may exploit these gaps to engage in illicit activities, knowing they are less likely to be detected. Competitive disadvantage. In today's business environment, transparency and compliance are no longer optional. Companies with robust AML frameworks gain a competitive edge by building trust with clients, partners, and regulators. For example, organizations with strong AML policies are better positioned to secure financing, attract high-value clients, and enter international markets. On the other hand, businesses with weak compliance measures may find themselves excluded from lucrative opportunities or facing higher costs, such as elevated insurance premiums. Industry-specific risks of weak AML policies. Different industries face unique challenges when it comes to AML compliance. Financial institutions, banks, credit unions, and payment processors are at the forefront of AML enforcement.